Good morning. Good morning, everyone. I'm Bag of Dawn at Stock Market Caddy. Today is Friday, December 3rd at 10:07. We want to give everyone an update. Back about 2 weeks ago, we made a suggestion to our members and a public suggestion that it might be a good idea to get an insurance contract or two on any portfolio of stocks that you have on a long basis because we were getting some indications that the markets were going to come under pressure. We're going to revisit those insurance contracts in a moment and show you what they would be worth, what they would cost. They're obviously going to cost a lot more to put those insurance contracts on now. And quite frankly, if somebody bought them, 2 weeks ago and can sell them, they might want to close them and sell them to some other party. But let's take a look at the futures markets. By the way, trading the markets is an acquired skill. You can trade the markets. We do day in and day out. It is an acquired skill. If you have the time, if you have the capital, if you have the passion to learn, we're here to help mentor you. We don't make any claims. We don't make any specific suggestions to buy or sell a thing. And we don't make any claims that you can and will make money. But we will do our level best to teach you how to trade the markets. And there's no limit to what a person can do. We have had members come in and do far better than us, and it is not a zero-sum game. Their success does not hurt us. But let's just take a look at what the markets are doing right here, right now. This is the S&P futures contract. On a 1-minute basis, it went short at 9:39 this morning. That is, they started selling. If you had placed a mini futures contract 32 minutes ago, 32 minutes, just one, you'd be up $2,300. Now, I'm asked all the time, well, how much money does it take to do that? A minimum of about $7,000. You want to have a little bit more than that in the account. So on a percentage basis, not too bad, huh? That's how those banksters get to build those big buildings in New York and Chicago. Because, folks, they're trading thousands of these things. They're not content to make, 10% a year. They're making 50, 60, 100% a day. Let's look at the NASDAQ futures on a 1 minute. 36 minutes ago, Swing Machine said to get short, you would be up $4,600 on one mini contract, using in capital about $8,000 to $9,000. So you almost got a 50% return in 36 minutes. Now, it is scalable. If you want to use a micro contract, it's 1/10 the amount of capital, and it's 1/10 the profit. So you wouldn't be up 5,000, you'd only be up 500. And by the way, the banks trade these in larger size than the minis, okay, and they trade thousands of them. The Dow Jones that you see reported on nightly by Bret Baier at Fox News, right? The Dow did this, the Dow did that. Well, the Dow is getting hammered here. The Dow only uses maybe about $5,000 or $6,000. It's up $1,000 in 34 minutes. The Russell 2000, the small caps, and that uses the least amount of margin. This only uses maybe $5,000 or $6,000. Don't hold me to it, but about that much. 42 minutes on Swing Machine, $2,000. Not too shabby, huh? And then, of course, gold and nat gas and oil and just about anything and everything else. You see, folks, stocks are a distraction to us. They really are. They're only open from 9:30 to 4. Those aren't even bankers' hours. The bankers work round the clock. The public markets, though, they're only open to you from 9:30 to 4. And you get what you get. From one day to the next, from 1 week to the next, from 1 month to the next. Now, I want to show you the options contracts that we had mentioned about 2 weeks ago. I want to show you those positions, and we're going to close a couple of them today. We're going to do that right now. Before I go too much further, if you want to call and speak with me, you can at 758-8263. If you want to learn to trade your game. Let me show you those options. Okay, you are looking at TradeStation's product called Option Station Pro. It is a superb product for buying and selling of options. Now, options are a little bit different than futures because they have a time element. And you might be asking, who in the world uses options? It isn't just speculators. You might call me a speculator, a trader. However, please understand, if you own a stock, if you have a portfolio of long-only stock, that is, all you've done is buy stock. When markets or stocks get extended, you may want to protect those profits. What are your choices? You could certainly sell it. Sell half of it, sell it all. And there are tax implications, and there's all the decisions that have to go in. Is it the right time? Is it not the right time? At certain times, if you have a person that you can work with, or better yet, you have educated yourself and learned how to trade options, you can move into the options market and purchase, in essence, an option contract, something that might be described as an insurance contract that would protect your account so that when prices go down, the option contract will go up in value. Think of it as an insurance contract for your house. You don't want your house to burn down, but yet you do have fire insurance. You don't want your car to get crashed up, God forbid, but you do have insurance on your car. You can, maybe not all the time, that's the beauty, you don't have to do it all the time, but during times when the markets are at extremes and there's uncertainty in the world, you can pay, it does cost, to insure your account. Now, if the accounts don't burn down, that's a good thing. You don't want them to burn down. And yes, you'll be out of pocket the insurance money that you paid. But if the stock market catches fire, you could be protected. So let me show you. This contract here is on the NDX.X, the NASDAQ. Approximately 2 weeks ago, we suggested to our members, if they had a long portfolio of a lot of stock, or if they wanted to speculate, they could have bought a put option. And let's take a look at this. This put option was purchased when the NASDAQ the strike price was 16,600. And the NASDAQ was trading at 16,600. And it expires on January 7th. It has 35 days left. Now, that contract cost, when we purchased that contract, $45,000. That's a lot of money. Now, you can do it in scale. You could do it less. In essence, one way to be looking at that was insuring a $1.6 million worth of stock. Or maybe your person was a speculator. Now, today, the market is trading at, the NASDAQ is trading at 15,794. It's lost 700, it's lost almost 800 points. So there is still a market for this option. Today, if a person wanted to buy that option for January 7th at that price, they're going to have to pay not $45,000, they're going to have to pay $95,000, because you see that contract is profitable by $50,000. It has more than doubled in value. That's a leverage position. So the person who has a put option, their account may be down a little bit, but those losses are offset by that option. We're going to hold that contract because we think that the market is going to fall further. the S&P 500. We did this on a smaller scale. Now, we bought something called a vertical put spread. Don't have enough time to explain that, but we kind of split the baby. It only has 20 days left. It expires on December 23rd, and we paid $51.80 for it. And if we close it today, we bought it. If we close it, which we're going to do, we will profit $5,000, 100% return. So how do I do that? I simply highlight it and I say to the market, close the position. And it's gone. Gone. And I now have $5,000 in my account. Cash. Now the NetEase position, we did this as well, and we'll open that up. And that's only got 7 days left. And I put my maximum risk, by the way, the cost, this was the maximum risk, was $2,275. And it had been down 50%, but it's up $275. And I want to get rid of that too. So I'm going to highlight it, and I'm going to close that position. And you're going to see it disappear, and it is gone. Now, so I have my cash back, plus $5,000, plus $200, $300 there on the NetEase, and I have one put contract here that is worth, if I close this, someone's going to buy it, not for $45,000, but for $95,000. Don't concern yourself with who, doesn't matter. You see, the traders and speculators, they are the people that enable the markets to function. So that when you want to buy stock, or you want to sell stock, or you want to insure, or you want to do whatever, you have liquidity in the markets. If you don't have traders and you don't have speculators, they're not taking money from you. They're making markets. They're market makers. If you don't have them, then you don't have a market. And you would have everybody on one side. I'm Bagadon at StockMarketCaddy.com. If you want to learn how to trade the markets a little bit, or maybe you just want to learn so that you can ask your broker or broker a question or two, feel free to give me a shout. Feel free to visit StockMarketCaddy.com. Again, we're not making a recommendation or a suggestion that you should do this, or you should not, or that you should buy or sell anything. And we're not making any claims at all. All we're trying to do is act as a mentor for you to help demystify these markets. It does take time. It does take work. Most brokers don't want to be bothered. Good luck, everybody.